So can you beat the market? Can you beat the stock market? Can you outperform the stock market? Well, what does that even mean? Well, it means, can you earn a higher rate of return on your investments than what the stock market would provide you, than what an index fund would provide you? And what's an index fund? Well, it's just buying some mutual fund or ETF that tracks whatever index you're talking about. So there are S&P 500 indexes. There's one Dow Jones ETF that I know about. There are ETFs that track the NASDAQ. But the most common by far when it comes to index funds that you can invest in is the S&P 500 index. Just about every major mutual fund and ETF provider has an S&P 500 index that's extremely low cost that you can invest in and just put your money away there. And the benefits of doing this is you don't really have to think about it, right? Index fund investing, you don't really have to think about it. You just put the money away into the index and you'll make whatever return the market makes over time. And historically, the stock market has performed quite well. The S&P 500 historically has been around 10% per year when it comes to long-term returns. Okay. Now, this said, there are other things you can invest in. Obviously, you don't have to invest in index funds. You can buy your own stocks, right? You can choose stocks that you want to invest in. You can choose other types of mutual funds that you want to invest in. You can choose different types of ETFs that you want to invest in. You can invest in certain sectors. You can invest in different asset classes, bonds or commodities or whatever it may be, right? You can invest in all these different things. But the question is, in doing so, can you actually beat the market? In doing so, is there a possibility that you can make higher returns? Because the only reason that you should make your investing more difficult, the only reason that you should make your investing more complex than just buying an index fund is if you believe you can make higher returns than just investing in an index fund. Or you believe that there is a better risk-return relationship. Because for some people, a stock index fund is not going to be indicative to the risk profile that they have. So they may, alter their asset allocation maybe towards bonds or more towards other types of fixed income that are not indicative of what the stock market does. But the whole idea is that you want to make a greater return than the S&P 500 or the market if you are picking your own individual investments. Otherwise, why would you do it? Otherwise, why would you invest in anything but an index fund? Well, I have good news and I have bad news. The good news is that it is possible. The good news is you can learn from people who have done it and you can try to make it happen for yourself. And we'll talk about how here in a little while. But you can do it. The bad news is that it's really hard to do it, okay? It's really hard and really unlikely, okay? And so let's talk first about how unlikely it actually is that you can beat the market. And we're going to start with talking about actively managed mutual funds, okay? And so there has been research done, and these reports are up to and through the year 2019, right? So we're looking about a year back when it comes to performance. But over the long term, these trends have held. So I don't want you to think that I'm cherry picking. This is 100% the case. According to this report from Standard & Poor's, 88.99% of large cap, meaning large companies, large capitalization, their market capitalization is large, right? Large cap U.S. funds have underperformed the S&P 500 index over a 10-year period. 88.99. That means that only 11.01% of actively managed U.S. large cap funds have beaten or even equaled the S&P 500 over a 10-year period. So this is quite the revelation. This is saying that even portfolio managers and mutual fund managers who are paid to do this, who are paid to try to beat the market, can't do it over a longer period of time. And even more than that, over a 15-year period, 90.46% of large cap U.S. funds have underperformed the S&P 500. So less than 10% actually outperformed. At less than 10% were actually able to do what we are talking about and what we are trying to do in today's episode. There are several reasons why, right? There are several reasons why this may be the case. Some of the reasons include there's a lack of patience, right? When you're managing a portfolio, you're managing a mutual fund, You are constantly trying to make sure that you can lock in your returns, get your returns over the long term, whereas an index is not doing a lot of buying and selling and in this position or adding to this position or decreasing this position. It's just allowing the market to play out the way that it plays out. And so you end up missing out on more of the upside, right? You end up missing out on more of the companies that continue to do well over time, and companies that do bad enough, right? Or maybe companies that even go bankrupt, or companies that are on the brink of bankruptcy can fall out of an index like the S&P 500, whereas a portfolio manager has to make the decision in order to sell something out of their portfolio in order for you to no longer be invested in it. So these types of things can have a drag on investment returns in these different types of funds. Basically, the whole idea here is higher turnover. The more that they trade, the worse they do. The shorter their time horizons are on their investments, the worse that they do relative to the S&P 500. So it's extremely hard for them to make abnormal returns when it comes to investing in these particular types of funds. That's why when I'm talking about mutual funds, I'm talking about index funds, I'm telling you these things that are probably good for you to invest in. It's a good idea to consider indexed ETFs and indexed mutual funds, because it's hard to find mutual funds that will continue to outperform. Not only is it hard to find ones that will outperform, there's this argument out there that I've heard many times, well, just find the ones that outperform and invest in those. Well, that may sound good to you, but if you look at the research that has been done, just because mutual funds outperform in the past does not mean they're going to outperform in the future. There are very few, very, very, very few that have sustained their outperformance over the long term. And then some of them that did sustain outperformance for a long period of time ended up just kind of falling in line with the market. Why? Because if a fund gets large enough, right, or an ETF gets large enough, it's going to be more and more difficult to try to find investment opportunities external to just a broadly diversified market that would allow you to make abnormal returns, because the more money that you have to invest, the further you have to spread it to try to get the same types of returns. And so it becomes very, very difficult to do so. That's why a lot of mutual funds will make really high returns in their early years, and then those returns will kind of dwindle as the years go on because they will get so large. Because obviously if you're doing so well, people are going to flock to your mutual fund. But that does not mean that you will continue to do well over the long term. Now, that said, you can find perfectly good actively managed mutual funds that will provide pretty good rates of return. But over the long term, are they going to outperform the S&P 500? The answer unequivocally is likely no. And we're not even taking into account here the idea of dividends, right? With the S&P 500, you know you're going to get whatever dividend yield that is offered by the collective companies in the S&P 500. Whatever mutual fund you may be investing in otherwise may not have dividends that are commensurate with those of the S&P 500. Therefore, that is going to eat away at your ability to reinvest dividends and earn more on your investments over the long term as well. And so the odds are pretty stacked against you in order to beat the market in some type of fund when you are trying to invest for your future. If you're trying to find some fund that's going to outperform the market, it is going to be extremely difficult to do so. And it may be good over the short term, 5 years, 10 years, but if you look 15, 20, 30 years into the future, the S&P 500 has a way of just beating down these other funds that try to give it a run for its money.